Welcome to Maintaining a Trustworthy Trust Account. If you downloaded this seminar online, there are handouts that go with it, including the rules regarding trust accounts, a trust accounting workbook, and a copy of the note slides. Let's begin. First of all, we want to talk about what goes wrong with a trust account. The course will cover both the record-keeping requirements and the rules and some other issues that are important to you. Most importantly, inadequate training. The lawyer is responsible for providing training, and this often does not occur. Inadequate record keeping, not knowing what records are required and how long to keep them. Inadequate internal controls and safeguards, never auditing your internal controls or how the trust account is managed and maintained within the law firm. And finally, no written confirmation with the client on how trust funds will be accepted, held, and dispersed so that the client understands why you're holding the trust funds. We're going to go over rules relating to trust accounts, starting with Rule 1-3.6G. Florida Bar members who fail to sign the trust account certificate will be deemed delinquent and ineligible to practice. The annual trust account certificate is a part of the Florida Bar annual fee statement form. Next, there are two Florida statutes that have nexus to trust accounting. One is covering title agents and their escrow accounts, and that's Florida Statutes 626.8473, and we will cover that later in the course. And the other is Florida Statute 717, and that regards how to treat abandoned property, or if you have an amount in your trust account and you cannot find the client. Although that should never happen, we do understand that occasionally it will happen. Don't overlook ethics opinions. The ethics opinions offer guidance. They help you develop the proper processes and procedures to effect compliance with the rules. They're important tools in understanding the rules. The Florida Bar ethics opinions relating to trust accounts, they include Ethics Opinion 60-26, 63-14, 70-13, and 02-8. These all are regarding relationships with banks and investment houses. Ethics Opinion 61-15 regards when you're in a situation where you cannot locate your client. 63-3 is also addressing missing clients and also file retention. 73-5 is misappropriation of funds by a partner. It's a serious circumstance, and everyone that has a trust account should read all of these ethics opinions, including 88-11 reconsidered on file retention and other aspects of maintaining files. Inside a lawyer's files are often the supporting documentation to transactions within the trust account. And finally, 93-2, which covers the treatment of retainers and advance fee deposits and cost deposits. Note, Florida Bar Ethics Opinion 21-2, which allows the use of payment apps to receive funds into the lawyer's trust account. Often, a lawyer's bank will offer a good banking arrangements for the law firm and its partners if the law firm moves its banking business to that particular bank. This is fairly common practice, but lawyers should be very careful when approached by a bank for special banking arrangements, and it involves also moving the trust account to that particular bank. A lawyer may not gain a favor or take advantage of the fact that he has a lot of money, for instance, in the trust account. That perk, that privilege belongs to the client, and we have two ethics opinions that address that. First is Ethics Opinion 63-14, and I will read from it. No attorney is permitted to make a secret commission on placement of a client's funds to obtain commissions from an outside source without the full knowledge, approval, and consent of the client. The other ethics opinion is 70-13. An attorney may receive a fee for referring a client to a financial institution, provided that the client consents after full disclosure and the client receives the benefit of the referral fee. So please note these two ethics opinions and add them to the list of ethics opinions that should be reviewed when managing a trust account. Managing a trust account is the lawyer's personal and fiduciary responsibility, and it cannot be delegated. The lawyer is responsible for the acts of its employees and the lawyer's agents, the law firm's agents. The lawyer is responsible for providing adequate, sufficient training and supervision regarding the trust account. So if there's a mistake in the trust account, it's the lawyer's responsibility. The fault lies with the lawyer. And the rule there is 4-5.1, responsibilities of a partner, managers, and supervisory lawyers. And I'll read an excerpt. The lawyer shall make reasonable efforts to ensure that the firm has in effect measures giving reasonable assurance that all lawyers therein conform to the rules of professional conduct. When the bar is talking to members or we visit a member's office, we look for the institutional lack of control. In other words, are there proper procedures, processes, policy in place so that the law firm is safe, the law firm doesn't get into trouble? Lawyers have a duty to report misconduct. And it is a very important concept to remember when managing a trust account. Are all trust accounts IOTA accounts? And no. Oftentimes, practice management advisors talk to members and they have all their trust funds in one IOTA account, even though they may have been holding certain portions of it for a very long time. And then afterwards, when the matter related to these trust funds comes to fruition or comes to a close, is going to be completed, the client asks for their interest. Not all funds are destined for the IOTA account. When money is not short-term, it's not nominal, and doesn't have to remain liquid, that money should be put into a separate interest-bearing trust account for the benefit of the client using their tax ID number. Not the Bar Foundation, but the client's tax ID number. These funds must be held in an eligible institution, and we'll talk about the definition of an eligible institution just a little while. Or if the client wants the funds held elsewhere outside of FDIC and FSLIC protection, you must get written directive from the client as to where they want those funds held. An eligible institution is an FDIC or FSLIC insured bank, or NCU SIF insured credit union. The investment company must be registered to do business in Florida. It has to have offices in Florida and must be registered with the SEC. The bank must offer the highest rate of interest that is offered to non-IOTA accounts, meeting minimum balance requirements. So what is an IOTA account and what goes into it? It's a trust account that's enrolled with the Florida Bar Foundation, which is headquartered in Orlando, Florida. The IOTA program is the Interest on Trust Accounts program. The money that goes into an IOTA account is nominal amounts of money, as I mentioned before, held for short periods of time, or where the amount, it's not practicable to invest it. The lawyer must use their own discretion, their own best judgment, as to whether or not an amount of money should be separately invested on behalf of a client or deposited into the IOTA account. Opening a trust account, what is specifically required? First, the naming of the account is very important. The rules say that it must clearly state that it is a trust account and use the words trust account. So escrow account is not correct. Costs account, settlement account, although settlement might be used in the title, it has to say trust account. It doesn't have to say IOTA, but also using the words IOTA account is also not correct. We have to use the word trust in there. So for instance, John Smith, attorney, trust account. The Smith, Jones, and Brown, PA, trust account. Those are correct. To say Brown and White escrow account is not correct, and it is a violation of the rule. Continuing with what is specifically required when opening a trust account, you must instruct the banking institution in writing to notify the Florida Bar if a trust account check is returned non-sufficient funds. And we have a form letter on the Lomas website as well as the other IOTA forms for opening the account. There is no ATM access on a fiduciary account, ever. So that is not absolutely prohibited. No ATM access. And also because trust accounts are fiduciary accounts, there is no automatic overdraft protection. That cannot be allowed. If the bank, and sometimes banks we know that they do this, the banks have asked lawyers when opening trust accounts, do you want overdraft protection? Do you want a debit card with this? Do you want this chained to your operating account, all for the purposes of overdraft protection and debit card access? And the answer is always no to all of those. No ATM access and no overdraft protection. Finally, you have to start the account with an initial deposit. Sometimes this is referred to as seed money, but the initial deposit is the lawyer's own money, the firm's own funds, and it's usually about $100 or an amount necessary to take care of bank charges, housekeeping expenses of the account, such as ordering new checks or deposit books. When the account is open and you set up your first set of books on this trust account, the first ledger that will show this first deposit is called the firm's miscellaneous ledger. And it can be replenished from time to time as that small amount of money is exhausted. And this bears repeating when opening a trust account. Please remember an FDIC or FSLIC approved institution unless you have permission to place the funds, say for instance, with a stock brokerage or an other investment house. You must have that permission in writing. This is rule regulating the Florida Bar 5-1.1 G1D. Please remember that the bank must also be in the state of Florida. Additional precautions when opening your trust account. Wherever your office may be, the banks are not necessarily responsible or do in-depth training on lawyers' trust accounts. So one of the things that can happen to you is that your trust account could be opened incorrectly. In fact, the bar often says that the two people most often to get a lawyer in trouble with their trust account would be the banker or their accountant, because it's likely that the banker and the accountant and the firm's accountant haven't read the rules of trust accounting. Make sure that they understand those rules, and probably should take a copy of those rules with you the first time you open your trust account. Open the trust account downtown in the main branch of the bank you choose, downtown where there's a high concentration of law offices. So likely the bank's staff is accustomed to properly opening a lawyer's trust account. Later, if you should choose to use a branch in maybe a suburban area or outside of town, that's okay because the account has already been set up and set up properly. The bar recommends that you use different color of checks. So one color for operating and one color for the trust account. Late in the afternoon when everyone's tired and everyone's busy, it is very easy, the hand is quicker than the eye, to grab the wrong set of checks and then result in a violation. So be sure to use different color checks. Never get a stamp of your signature. It's convenient, and but it's very dangerous, and it could lead to theft. Never, a lawyer actually should never make a stamp of their signature at all. Who can be a signer on the trust account? Is actually in our rules, it's anyone the lawyer designates. And who should be a signer should be the owners of the law firm. The owners of the law firm should be the signatories. This is not always practicable for solo practitioners, though, so be very careful about who you authorize to sign on the trust account. Be sure that when you're opening the trust account that you take the forms with you, and as I said before, the forms are on the website. The forms are also at the Florida Bar Foundation website. One of those forms is a W-9, which has the Florida Bar Foundation's tax ID number on it. Make sure that that tax ID number is used when opening the trust account and not yours, which is actually a very common mistake. The bar recommends that you notify the bank in writing that there'll be no disbursements or transfers or wires without your specific written permission. This is very important. The bank often encourages lawyers to enroll in online banking, so they are, conducting live transactions, and this is very dangerous. Anyone who gets your password is off to the races. There are other banks here in Florida that have restricted that ability with fiduciary accounts, including lawyers' trust accounts. In other words, you can have online access to view transactions and to check your balance and to see if a check has cleared, but you can't make a live transaction online. Several banks have pulled back that ability because, after all, it is a fiduciary account. When holding client property, remember that the same rules that govern the money govern the property. Please refer to the rule of safekeeping property 4-1.15, where it instructs the lawyer that when holding client property to follow the trust accounting rules. So this means no commingling. We have to keep the law firm's property separate from the client's property. Securities must be held in a safe deposit box. The bar recommends that any valuable client property that could be stolen for profit or valuable property should also be locked up in a safe deposit box where practicable. If you can't lock it up in a safe deposit box because of its size or the volume of it, find other very safe storage, secure storage for this client property. And also, when taking in client property, remember that you get a notary, get an appraiser, take photographs, have descriptions, protect the law firm. When we are handling trust account funds, first of all, we take money in. First thing that happens is we must give the client a receipt. And many lawyers will tell me, well, isn't there a receipt the canceled check? Or, well, they know that we're taking the money in. I'd say, no, the rules say give the client a written receipt. So incorporate that part of the rule into your procedures so that you know that the client is getting the written receipt when you take in a trust account deposit. Make only those disbursements that your client authorizes. Well, of course, and saying, well, they know what I'm going to spend the money on. And we tell them, is it in your fee agreement or your letter of representation? Do we spell out how we're going to make disbursements, to why we're going to make these disbursements, and when we're going to make these disbursements? And finally, promptly return the trust account funds when requested by the client. I will refer you back to your intake process. Look at the way you intake new work, and if that new work has nexus to the trust account, do we just describe all of this? Do we say, if what will happen if the client asks for the money back? I mean, does work will stop, for instance? What are the repercussions of that action? We discuss what disbursements we're going to make. We discuss how we take the deposit in and where that deposit is held and the fact that it is in our trust account. I'll probably say this several times during the presentation, but when handling trust account funds, remember no commingling. Keep the lawyer's property, the law firm's property, separate from the client's property. Disputed fees cannot be withdrawn. If part of the money that was taken into trust was to pay your fee and the work is done and you take the money out to pay the law firm's fee, and then later or soon after the client disputes this, you have to put the trust funds back from operating back into the trust account. Disputed fees cannot be withdrawn until the dispute is resolved. Provide a written accounting to clients when requested. If the client says, I don't understand what you did with my money that I gave to you, or the client just asked for a routine accounting or any kind of an accounting of the money that you're holding in trust, you must provide it timely. Withdraw earned fees immediately. You can't have the firm's earned fees in the trust account with the client funds because that is commingling. It also could potentially be evading taxes. So when the firm has earned the fee, they must remove it from the trust account. There are some fees that the client may give you that never go into the trust account, and these include non-refundable retainers, flat fees, and of course a true retainer. A true retainer is when a client pays a lawyer for the right to hire them in the future. All of these, in fact, the word retainer itself means that it's earned. It is a payment when you receive it, it is already earned. These retainers go into operating. They never go into trust. Now, on the other hand, a client may give you a payment that includes both earned fees and an advance fee payment and a cost deposit. So, for instance, the client gives you $7,500 and the fee agreement is that $2,000 of it is non-refundable and earned upon receipt, and $5,000 is an advance fee payment after a certain point in time in the case, and then finally $500 is an advance cost deposit. The single payment would be put into the trust account, and as soon as that check clears, then you would write a $2,000 check out of the trust account back over to operating because that was the portion that was earned upon receipt. When must you make disbursements from the trust account? Well, immediately upon the client's request. So again, let's go to our intake process. And how did we describe how we're going to make disbursements with the money that we're going to hold? Did we adequately explain that? We should have a written agreement with the client when we are going to hold money in trust. If you're handling several matters for one client, to have a ledger for each matter. Never transfer money from one client's ledger. Say the client has multiple matters and you have a ledger for each matter and you're short some funds on one matter and you want to transfer it over, from another ledger. You shouldn't do that without verifying the funding source to make sure that it is all, that particular client's funds. And I'll explain that. If you have a software system for managing your finances, as most of us do, and you open up a new client comes to you and it's the first matter, and you open up that matter, and you're going to hold trust funds, and the work is done, and then the client comes back after the work is done with yet another matter, except this time they come with someone else who's also going to be your client, and perhaps it's a joint venture, for example. In your bookkeeping office, they may see that intake, and they may even be instructed to do this, but they'll look at this intake and perhaps open a second matter under the first client. Instead of looking at it as a new joint venture and a new client, over here, client number 2, ledger number 1, client 1, ledger 1, client 2, ledger 1. So instead, what they'll see is this returning client and open up a second ledger in the trust account when in fact that's a completely different funding source. This is a common mistake made in a law office, and care must be taken to avoid it. Liens and garnishments are permitted in a trust account. And I will read from the rule. Rule 5-1.1c, liens permitted. This subchapter does not preclude the retention of money or other property upon which the lawyer has a valid lien for services, nor does it preclude the payment of agreed fees from the proceeds of transactions or collections. Frequently, the bar is contacted telling a bar representative they have an amount of money in their trust account and they cannot find their client, or a check is not cashed, or other reasons. When this happens, and although it shouldn't happen, but when it does happen, the law firm, under certain circumstances, can escheat these funds back to the state of Florida's Unclaimed Property Office. The procedures for remitting these unclaimed funds are outlined in Florida Statute 717 and are detailed on the Department of Financial Services website. The website address is on your notes slides, but it is www.fltreasurehunt.org. And this is the Bureau of Unclaimed Property. As well, their telephone number is 888-258-2253, and their email address is floridaunclaimedproperty@myfloridacfo.com. Back to the subject, though, of having amounts in your trust account that are you can't return to the client because you can't find the client. Go back to the reconciliation process, and we'll talk more about that later. But in the reconciliation process, you should have a procedure in place so that we're verifying why funds are still on a ledger every month. Every month, if we have funds on the ledger and we know why, so that's appropriate. But then we go to the next ledger and we have funds on this ledger and the funds, were dispersed or they shouldn't be there. It's time at that point to contact the client and make sure we have fresh contact information. Far too often, the law firm personnel wait months and months and sometimes even years before deciding, well, what are we going to do with this amount of money that is remaining on the ledger that should not be there. ACH transfers are not prohibited in our trust accounting rules, but care should be taken when using an ACH transaction or any kind of other electronic payment system. What is an ACH? This is an electronic payment that goes through the automated clearinghouse. It's a process whereby the account holder is authorizing a third-party access to the account. So right there you can see it's a little scary, and care should be taken. I'm going to read to you an excerpt about using ACH transactions in conjunction with the trust account. There are concerns about using an ACH in conjunction with a trust account. While not prohibited, ACH transactions will not provide adequate documentation about disbursements. So while it is permissible to remit, for instance, our court e-portal filing charges via ACH from the lawyer's trust account, a safer way is to run the e-filing charge through the lawyer's operating account as a client cost advance. Then the lawyer can reimburse the firm from the client funds in the trust account after the payment of e-portal charges is completed from the operating account. More about ACH transfers and using other electronic payment systems. Please be aware that an ACH transaction can be reversed. So again, great care should be taken. However, it is an ACH transaction that is used when paying for filing fees through the court's e-filing e-portal system. The e-portal system, you can use either an ACH transaction or a credit card. The lawyer can pass along the e-filing charge to the client, and note that this e-filing charge is treated as an ACH transaction. Third-party access to the trust accounts is not prohibited, as we mentioned previously, but it does raise these concerns. So the Florida Bar auditors are aware of the e-filing portal fees via ACH, and at this time are not necessarily troubled by the arrangement as it is with the court. The bar recommends that the law firm open an additional low-balance operating account or a low-limit credit card to handle e-filing or other ACH transactions. In this way, accounts holding large sums of money, such as your trust account, are not exposed to the cloud. Florida Statute 626.8473 on title insurance agents. I'm going to read the excerpt from the statute. An attorney shall deposit and maintain all funds received in connection with transactions in which the attorney is serving as a title or real estate settlement agent into a separate trust account that is maintained exclusively for funds received in connection with such transactions, and permit the account to be audited by its title insurers unless maintaining funds in the separate account for a particular client would violate applicable rules of the Florida Bar. So how many IOTA accounts or how many trust accounts does a law firm or a lawyer need? And it's really a matter of you need as many trust accounts as necessary to efficiently operate the law firm. The Bar recommends that you have a trust account for each title company for whom the lawyer is an agent. In this way, when the title company comes to do their audit, or if they do their audit electronically of the trust account, you are only giving them the records for the closings in which this title company provided the title insurance. And in doing so, you will not have to expose other trust account records to the copying and redacting and the possible mistakes of releasing information that the title company should not see. So to repeat that, if, for instance, the law firm is an agent for 2 different title companies, then they should have a trust account for each of those title companies, and then there will be records for just that title company, and it's much easier to go through the audit in that manner. What happens when you have insufficient funds in your trust account? Well, it's a tragedy, to be sure, but as previously mentioned, the bank is required to report non-sufficient funds in SF situation to the Florida Bar, absent a bank error. The lawyer, if they should have insufficient funds or have an overdraft in the trust account, is required to report the situation to bar staff counsel. If client funds go missing from the trust account, the event, of course, must be reported to the Florida Bar's staff counsel. However, you should also immediately seek guidance from our bar staff auditors. In summary, as to trust account thefts, there are things that lawyers should do immediately. First, to call the bank and freeze the account. Notify the police and file a report. Notify Florida Bar staff counsel. And then the law firm's general liability and insurance carrier, because often there is coverage for a theft. And then next, the firm's professional liability insurance carrier, and then the client. And these steps should be done immediately, one right after the other. A trust account management plan for the law firm's trust account is a requirement as of June 1st, 2014. The requirement is discussed under Rule Regulating the Florida Bar 5-1.2c. This rule requires all law firms with more than one lawyer to have in place a written trust account management plan for each of the firm's trust accounts. This applies to both IOTA trust accounts and separate interest-bearing trust accounts. The trust account plan must be disseminated to each lawyer within the firm. The plan must include the full names of all firm personnel who are authorized to sign on the trust account, and the names of all the lawyers who review and approve trust account disbursements and deposits, and the names of all lawyers who have oversight of the trust account reconciliation process, one of whom must be a partner or shareholder or member of the law firm, and the names of all the lawyers in the law firm who serve as a point of contact for the other lawyers in the firm who may have questions about the firm's trust accounts. In a small law firm, these duties may fall to just 2 lawyers. Note that solo practitioners are not required to maintain a trust account management plan, but it is a best practice. So, in firms of 2 lawyers or more, There must be at least 2 lawyers responsible for oversight of the trust account. In a large law firm, some of these duties may fall to the law firm administrator, controller, or independent CPA firm. Nonetheless, all law firm staff, outside agents such as the firm's CPA firm, and the supervising lawyers must be named in the plan. Why is this rule necessary? Why must law firms maintain an up-to-date trust account management plan? One reason is because each lawyer with managerial or supervisory responsibility and/or an ownership interest in the law firm is responsible for his or her own actions relating to the trust account. Another reason is that if the trust account plan is circulated to all the firm's lawyers as required by the rule, this should help lawyers spot irregularities so they can be corrected and reported. Each time there is a material or significant change in the trust account management plan, a new plan must be prepared and distributed to all of the law firm's lawyers. An example of a material change would be the removal or addition of a signatory to the trust account. The trust account management plan must include the name of an owner of the law firm who is ultimately responsible for the firm's trust accounts and the trust account management plan or any part of the plan. The requirement to have in place a trust account plan applies to all law firms with a Florida office, including interstate law firm partnerships. There is a rule of 6 in all trust accounting rules from state bar to state bar and including the ABA. And this rule of 6, to help people remember the rules and remember their record-keeping requirements, is first we must have a journal. The cash receipts and disbursements journal must be maintained. There must be ledgers that apportion the money that's held in the account to the clients it belongs to. We must have a monthly bank statement, canceled deposit slips or detailed records of these deposits, proofs of wires and canceled checks or bank-made copies of these checks. 4, we must have a monthly reconciliation of the bank statement. We must have a monthly comparison, and we must hold the records and the supporting documentation for 6 years, and I will explain each one of these as we proceed. Whether your trust account records are digital or whether the lawyer prefers to keep a paper accounting method, the bar recommends that you can recreate these records during the entire 6-year retention period. It is critically important lawyers change software systems and then discard the old software and don't import the data into the new software. Lawyers can misplace paper records, or they can be damaged or destroyed or lost. So in the law firm's retention policy on files, be sure to remember the trust account and that we have that 6-year retention period on all the bank records, the other record requirements, and the supporting documentation. The 6-year retention period is not 6 calendar years. The 6-year retention period is 6 years from the date of the last transaction on any one ledger, on every ledger. It is important to make sure that this trust accounting retention period coincides with the retention period on client files. If the lawyer keeps routine files for only 3 years, but in fact there was nexus to the trust account, they may have lost some of their reporting documentation. Now, having said that, most lawyers keep their records far longer, but it is worth noting here that supporting documentation may be in the client files and therefore need a 6-year retention period. The bar recommends that you gather all the documentary support, copy it, scan it, and keep a copy with the monthly bank reconciliation. In this way, if the lawyer is ever challenged or questioned or audited, they won't have to go looking through hundreds, possibly thousands of files looking for the supporting documentation. So at the time of the transaction, at the time of the disbursement, we provide an extra copy, whether electronic or paper, and keep it with that month's reconciliation package. Examples of supporting documentation include disbursements and deposits. So it could be vendor invoices, law firm invoices, copies of the deposit slip itself, signed internal check requests. All of these are good examples of supporting documentation. There are additional record-keeping requirements on electronic disbursements. The record of electronic disbursement must be the same as if it were a check. And I'll read an excerpt from that. We must maintain other documentary support for all disbursements and transfers from the trust account, including records of all electronic transfers from the client trust accounts, as well as the name of the person authorizing the transfer, the name of the recipient, confirmation from the banking institution confirming the number of the trust account from which the money is withdrawn, and the date and time the transfer was completed. All of this information is required as supporting documentation to an electronic transfer. Wire transfers in particular are now covered by Rule 5-1.2d. Authorized electronic transfers from a lawyer or a law firm's trust account shall be limited to money required to pay a client or a third party on behalf of a client, expenses properly incurred on behalf of a client, such as a filing fee or payment to third parties for services rendered in connection with the representation, money transferred to the lawyer for fees which are earned in connection with the representation and which are not in dispute, or money transferred from one trust account to another trust account. These are the restrictions. This is what is allowed for wire transfers. To continue with record-keeping requirements, the Cash Receipts and Disbursements Journal is a chronological record of the transactions within the trust account. So it would include the date and the payee and the reason, the amount to which ledger it belongs to, the client matter, and then the extended, new balance. And usually a Cash Receipts and Disbursements Journal also has another area for notes involving the transaction. A checkbook stubs, the stubs in a checkbook or a simple checkbook register are not sufficient. Oftentimes when we open a separate interest-bearing trust account for the benefit of a client, it's not an IOTA account, the bank will give us a temporary checkbook, and that may be all we ever use for that account because we're going to hold it for such a short period of time, perhaps. And that is insufficient. You must have the Cash Receipts and Disbursements Journal for every trust account that the firm holds. We must have client ledgers, not just for each client, but also for each matter when that is applicable. The client ledgers and the Cash Receipts and Disbursements Journal should show the beginning balance for the month and the ending balance of the month. The Cash Receipts and Disbursements Journal, whereas it's showing you the chronological history of the transactions within the entire trust account, the ledgers show you the chronological activity of that matter for trust account transactions concerning that matter. We show all the transactions for each client's matter and the balance owed to each client on each matter. This is critical. Show the month end and the beginning of the month totals on both the ledgers and the journal. Here is a simple depiction of the Cash Receipts and Disbursements Journal and the client ledgers. So you show the journal has $3,100, and then it shows the four ledgers, and the amount recorded onto the ledgers must equal the amount that's showing on the Cash Receipts and Disbursements Journal. A trust account reconciliation is a three-way balancing. First, we do the monthly bank statement, and we reconcile it to the monthly Cash Receipts and Disbursements Journal. The monthly comparison is a total of the list of all the ledgers and their month-end balances, and that is compared and must agree with the adjusted ending balance for the month for the Cash Receipts and Disbursements Journal and the reconciled bank balance. Reconciled bank balance the adjusted month-end total of the cash receipts and disbursements journal, and the total of the monthly comparison must all agree. Another record-keeping requirement is the annual listing. The annual listing of all the ledgers is an additional monthly comparison, the 13th monthly comparison within a year. It is not a copy of any one of the 12 monthly comparisons. It's a 13th comparison. We call it the annual listing, and again, we list every one of the ledgers and their month-end balance. You can pick any month of the year to do the annual listing, but it must be done. Record-keeping requirements include that you have the original monthly bank statement. And I emphasize monthly because the bar has received calls over the years from members and their staff, and they say, well, the bank told me since I don't have much activity in my trust account, maybe I should just have a bank statement every 6 months. Don't let the bank talk you in to anything other than receiving a monthly bank statement because it is required. And it must be the original. Now, it can be a bank-made copy sent to you electronically, but it has to be sent from the bank. You have to have a detailed record of your deposit slips. Years ago, the bank would give you canceled deposit slips. Now they just list the deposits on the actual bank statement. So it's up to you to keep a detailed record of your deposits that match the information on the bank statement. This information that's required on your deposit history records is the date of the deposit, the source of the deposit, for instance, the Acme Corporation, the source of the deposit, the type of funds, the name of the client matter, and finally a copy of the check that was given to the firm to deposit, or a copy of the cash receipt. You must have original canceled checks or bank-made electronic copies. In other words, copies sent to you from the bank. Some people prefer to get their original canceled checks and even pay a small fee for that. But if they're electronic copies sent from the bank, that is sufficient. However, it has to include both the front and the back. I'll repeat that. It has to include both the front and the back of the check. The rules state that the canceled checks must include all information on endorsements. And that is on the back of the check. That's where all the endorsement information is. Make sure the bank usually will not do this without you asking them to do it. It's not their current practice today to give you canceled checks of the back. They'll just show you the front. So make sure that you're getting the front and the back. What we see here is a simplified example of the monthly bank reconciliation process. So for instance, if you're using accounting software to do this, this is one of the standard reports in your accounting software. If you prefer to keep paper records or use Excel, that will work. If you're using paper records, then you should have journal paper. Some people prefer to use Excel, and the bar has Excel forms on its website, templates that you can use for trust account reconciliation. Those are free. So first we start with the balance per the bank statement. What does the bank say that we have at month end? And we put that down. And then next we list any of our deposits in transit. What that means is the bank closed out activity before printing the bank statement at the end of the month from what they could see. So you, on the other hand, say made a deposit on the last date of the month, and it didn't catch when the bank closed out to print your bank statement. So it's a deposit in transit. So it's outstanding. So we have to add that deposit to what the bank says that we have, or any other deposits in transit. Next, we're going to list and deduct outstanding checks. These are checks that we know that we've written and appear on our journal, but they're not showing up as cleared on the bank statement. So we list each of those checks with the check number and the date and the amount, and we deduct those from what the bank is showing we have in our trust account. This should give you a reconciled bank balance. There could be some other items. It's neither a check nor a deposit. For instance, the bank charged you a wire transfer fee and you failed to record it. So at this point, you would make an adjustment to your cash receipts and disbursements journal, for example, for the amount of, say, this wire transfer. And now you have an adjusted month-end balance for your cash receipts and disbursements journal and agree with the bank statement. This should agree with the month-end balance of the cash receipts and disbursements journal and the total of the client ledgers. Again, it's a three-way balance. The reconciled bank statement, the adjusted month-end balance of the cash receipts and disbursements journal, and the total of all your client matter ledgers. That's the monthly comparison. The monthly comparison, here is an example. It's a simplified example, but for discussion purposes. And it shows the first being our law firm miscellaneous ledger, has a small amount of money on it. We have 4 clients, client A, B, C, and D, and the total of this monthly comparison should equal the cash receipts and disbursements journal month-end adjusted balance and the reconciled bank statement balance. 1, 2, 3. Credit card transactions are allowed with both the operating account and the trust account. However, when taking in a credit card payment into the trust account, there is a merchant card fee for the transaction. Credit card merchant transaction fees may be passed on to the cardholder. When handling retainers and advance fee and cost deposits, knowing the difference between a retainer and an advance fee payment or a cost deposit is very important. And I refer you to Ethics Opinion 93-2. And if you need more clarification on that ethics opinion, I urge you to call the Florida Bar's Ethics Hotline. First of all, to understand the types of retainers, a true retainer, as we mentioned earlier, a true retainer is when the client pays the lawyer an amount of money for the right to hire them in the future. In the legal marketplace, this is also sometimes called a conflict retainer. The client pays a law firm to ensure that a potential opposing party will not hire the same law firm. The true retainer is considered earned the moment that it is received by the law firm, and so therefore it goes into the operating account and not the trust account. Earned fees are never put into the trust account. Next are flat fees and non-refundable retainers. Those are also considered earned the moment that they're put into the lawyer's hand and they go into the operating account. They never go into the trust account. Advance fee and cost payments to be applied to fees and costs incurred in the future. Some people also call this a refundable retainer, which is actually an incorrect term. The advance fee and cost deposits that do go into the trust account, those are refundable on demand by the client. I would refer you back to your intake process. Make sure that your retainer agreement, fee agreement, representation letter, whatever that document is that you use when intaking new work, that it goes over this information if it's applicable, so that the client has a full understanding of what the money will be used for, how it's being taken in, whether or not it's refundable. And guess what type of retainer you have if you don't have a fee agreement. If the client comes back later and says, I want you to stop what you're doing and give me back my money, and you say, well, it's non-refundable. If there's no written agreement, it's refundable. Disbursements against uncollected funds. Our rules tell us to wait until the funds are collected, and it gives us certain exceptions upon which a lawyer, in their own discretion, in their best judgment, can disburse when they know the funds have not yet been collected. But the rule says may disburse. It does not say shall disburse. So be very, very careful, because if you should decide to disburse on uncollected funds under one of the 6 exceptions, and that goes south on you, you're holding the bag. You have to make it good. It's your error, it's your responsibility. And having said this, it's a good time to talk about scam artists. There are lots of criminals out there that actually know this part of our rules, and so therefore they're going to try and scam lawyers. So what they do is you may get an email saying, would you accept a collections matter for me? And they outline the various collection details. And then a few days later or a week or so later, they say, I'm not sure what you did, but our customer paid. And we're just thrilled. We're going to send you the cashier's check that they sent us instead of to you. And we prefer that you go ahead and run it through your trust account and withdraw your fee and then wire us the balance. This is a scam. The cashier's check is not real. It's a good fake. Beware of these type of scams, because advancing funds on an uncollected instrument such as a cashier's check is one of the 6 exceptions, which I will show you each one in just a moment. So you deposit the cashier's check, you then wire the so-called client's share and retain the agreed upon fee, and 10 to 20 days later your bank comes back and said this was a fraudulent cashier's check and you have to make it good. And this could be a huge sum of money that you've released based on one of the 6 exceptions, because it's almost always a cashier's check. Be very careful when intaking a client, verifying their identity, verifying their location, getting all of the bona fides so that you know who you're dealing with, and not ending up with a potential scam situation on your hands. Now, on to the 6 exceptions. The 6 exceptions that allow for immediate disbursement on uncollected funds include, of course, the cashier's check or the certified check. If you take in a cashier's check or certified check and deposit it into your trust account, you can then disburse on it if in your best judgment it's a good check. Loan proceeds from a bank or institutional lender is the second exception. You receive proceeds from a loan from an institutional lender or bank doing business in the state of Florida, then you can disburse on that. The third exception are bank checks, official checks, money orders, and within the state of Florida, credit union checks. So be very careful though with bank official checks. Oftentimes they're written outside of the state of Florida, so the bank is within the state of Florida, and you receive an official check. It'll say official check. Sometimes it's also referred to as a money order, but it doesn't say money order. It says official check. And then you look at the maker of the official check, and it's a subsidiary of your bank, but it's in another state altogether. Note that the clearance time is going to be longer than if it were an in-state or local check. The fourth exception are federal or state government checks. If you take a federal or state government check into the trust account and you feel that this is a good check, then you can immediately disburse. The bar recommends that you beware of forgeries. Number 5 are checks on another Florida lawyer's trust account or the escrow account of a licensed real estate broker in the state of Florida. If you receive either one of those instruments and deposit it into your trust account, and you believe this is a good instrument, then you may disburse on it before the funds are actually collected. And finally, our 6th exception is checks issued by insurance companies licensed by the state of Florida to do business within the state of Florida. Lots of caution here, because insurance companies have been known to actually issue a draft to the lawyer and not a check. And there's a difference between a check and a draft. A check is a demand to pay, and a draft is a request to pay. If the insurance company should give you a draft, they don't have to pay on it until they're ready to. They could make you wait months before they actually pay on it. So be careful that if you are receiving this instrument from an insurance company that is in fact a check, because if you do want to disperse on it before it is collected, you want to make sure it's a check and not a draft. In summary, on the 6 exceptions that allow immediate disbursements from the firm's trust account, if you're a new lawyer and you have a new trust account that may not have any funds in it, and you disperse on a deposit under one of these 6 exceptions, you could be putting yourself into an NSF situation. Also remember, if you should disperse based on one of these 6 exceptions, and it should go south, in summary, you're the guarantor, you're responsible, and it's going to end up at your doorstep. Trust accounting and your employees, we kind of covered this earlier, but we're going to go into detail now. And so who should sign checks? Who is allowed to sign on the trust account? Currently, it's the lawyer and anyone the lawyer designates. In a law firm, it should be just the owners. But for sole proprietorship, that may not be practicable, and they may have to ask another person to be a co-signatory or a full signatory. But it should be the owners of the law firm who are the signatories on the account. In huge firms, really, really huge firms, often the controller is a co-signer on the account for large sums of money. In small to mid-sized firms, the bar recommends that an employee never should be a signer on the trust account. You should consider 2 signers for large sums of money as an internal control policy. It's usually not something that the bank will honor, but that's not the purpose of having the 2 signature lines with the fine print saying 2 signatures required for amounts over $10,000 or $25,000 or $50,000. That's an internal control policy so that everyone knows that the check shouldn't leave the office until there are 2 authorized signers on the check, thereby releasing the funds. Trust accounting and your employees. The bar recommends that you run a criminal background check on all prospective employees. The Florida Department of Law Enforcement can run this criminal background check at a low cost. You should notify the employee that you're going to run the criminal background check, and you should never hire anyone before running the check. However, some firms may want to give a contingent offer of employment saying, but for the results of this criminal background check, we would like to offer you the job. The firm should check with their general liability insurance carrier to be certain that they're carrying enough coverage. It's usually a standard rider, the fraud and theft coverage in general liability insurance policies, but make sure that it's adequate to cover a theft in the trust account. You should review your firm's internal controls. The bar has a self-audit on its website that includes a trust accounting section so that you can, in the privacy of your office, look at your internal controls. However, we're going to cover some internal controls now. Additional precautions in maintaining control of the firm's trust account is never write a blank check, never sign a blank check, don't release blank checks. Store checks in a secure location. Oftentimes a firm will go through its internal controls only to find that the one thing that they're doing that's risky is that the blank check supplies are in an open location. Check supplies, bank statements, bank records all should be under lock and key. Pre-print checks with void after 90 days is always good advice. And sequentially number checks. Now, when you're reordering checks on the main IOTA account, of course they're going to be numbered. But when you're opening a separate interest-bearing trust account, again, the bank may give you a temporary checkbook and the checks are not numbered. If that's the case, stop before you leave the bank and ask them to number the checks because they have the printer there on site that they can number those checks for you. Additional precautions include, as we mentioned earlier, never allow a stamp to be made of your signature It's just dangerous. Never make checks payable to cash, so no blank checks and no checks payable to cash. The requirement is always there, the IRS requirement to report large sums of cash. Cash sums of $10,000 or greater must be reported to the IRS. And always remember to receive your trust account unopened. If that's not possible because you're a solo practitioner, you can have a copy of the bank statement mailed to your accountant. But someone not in the reconciliation process should receive the bank statement unopened and inspect it before it is handed over for the monthly reconciliation work. Don't create invitations to steal. Separate duties, it just takes two people. If there are just two people in the office, there are many internal controls that we can implement. At least two people, one person makes the deposits and another person posts the deposits. One person writes the check and another person signs the check. One person makes journal and ledger entries and another person reconciles the bank statement. It just takes two people. And always remember, cross-train your staff so that you have extra pairs of ears and extra pairs of eyes who know how a trust account should be managed, watching out for the firm. Red flags of embezzlement include personality changes, a family crisis among anyone on the law firm's staff, sudden unemployment of household members. Desperate people will do desperate things. Extravagant living, overprotective. An employee is overprotective of their work, an employee who won't take a vacation. Addictions discovered. It's discovered someone on the staff has a gambling addiction, drug addiction, alcohol addiction. This is very dangerous, and this person should be cut out of any nexus to the firm's money or the client's money. Law firm owners that do not receive their bank statements unopened or do not review their account reconciliations, that's actually considered a red flag of embezzlement. If you're not reviewing your statements thoroughly every month, that's an opportunity for theft. In summary of our presentation today of maintaining a trustworthy trust account, ask questions. Remember that the key words in proper trust account management are personal oversight. If a lawyer or legal administrator does not understand the bank statement reconciliation documents, supporting materials, the trust account management plan, or any step in the processes relating to the handling of the law firm's trust account, demand answers from the persons responsible. Never hesitate to contact the bar's ethics hotline. Thank you.